So what could this be telling us? Well, it's telling us that the central banks are going to have to step in and inflate the system massively. I think there's trouble in the credit markets, in the financial markets, in the banks, not just in the US, but Western Europe, the UK. And we know that the Fed's going to end quantitative tightening by the end of this month. And I even think the head of the New York Fed, the most powerful of the regional banks, said that they're probably going to have to do QE again because they need to help the bottom 50%. So I think it's only a matter of time. And I think Jay Powell as well, he's going to be leaving in May next year. So yeah, he might want to kind of make sure things go smoothly before he retires. And even he spoke about the wealth inequality in the last FOMC press conference.
Inneco explains that the Bloomberg Commodity Index is breaking out of a multi-year base, signaling a new wave of inflation. He cites Rick Rule, who noted that U.S. debt and unfunded liabilities now nearly equal the nation's $168 trillion in wealth, meaning default will come through inflation, not non-payment. The index, 30% energy, 23% grains, 15% industrial, 19% precious metals, has surpassed July 2023 highs, showing a broad commodity rally. With the Fed ending QT and discussing new QE, inflation risks rise. Silver's move above $51.15 is bullish, while gold lags near $41.34. Commodities are set to surge. Use corrections as buying chances. Thanks for watching. Subscribe to Fine Metal for more updates.
And basically he went through all the numbers, fiscal numbers of the U.S., how much wealth the U.S. has. Like I think 168 trillion is the net equity of all U.S. wealth. And then he went through the 31 trillion net public debt. It's not debt owned by U.S. agencies or the Federal Reserve, right? And then he went through the unfunded liabilities and also the deficits that the U.S. Government is running every year. And we are almost at a point where all these obligations and debt is matching the net wealth of the U.S. And he doesn't think that the U.S. will default. It won't do something like Argentina has been doing for the last century, because politically they just kick the can down the road. And the default that they're going to do, of course, is through inflating the system. And actually, what I'm going to talk about today about the Bloomberg Commodity Index, how it's pointing to inflationary pressures, I think matches that. So he thinks, it's not contrarian anymore, but the reason to have gold exposure is still there, and it's a fiscal reason and political reason as well. Politicians and even the general public, they'd rather have inflation than a major deflationary collapse like during the Great Depression. So you can see here how the commodity index rallied quite strongly from that March low, and it topped in June of 2022, and then it's been really in the bear market since then. It made a bottom sometime in May 2023, and then it's been going sideways. It's made a new bottom, but it's been going sideways, and now it's starting to break above. We've actually broken above the July 2023 high, and also the April 2023 high, and that's very bullish. That will get the momentum speculators and investors into general commodities. I think first is where is it? Is the chart of gold and the Bloomberg Commodity Index, and I've compared them. Going back to July, I think 2016, and it starts at 100, and you can see that gold has outperformed. Gold is up 331% since July 2016. The Bloomberg Commodity Index is up, well, it's at 123, so it's up 23% only. And if you look at in 2020, the Bloomberg Commodity Index dipped very sharply, just started dipping sharply just before the correction and the crash that we saw, the COVID crash. And it bottomed in March, just like gold did. But gold started taking off and traded up. I remember at the time, I think it was over 2,000 by the summer, while the Bloomberg Commodity Index, it started trading higher, but it was nowhere near the previous high prior to 2019. It only took out that high sometime in the summer of the next year, in 2021. Excuse me. And then it kept going up while gold corrected, right? It went sideways. And then in March 2022, gold went down, and the Bloomberg Commodity Index also went down. And it's been on a sideways pattern since I would say the summer of 2023 or spring of 2023. While gold actually has started catching up and making new highs from early, I would say early last year, spring of last year, and it's continued to do so. But now, and we're going to look at just a chart of the Bloomberg Commodity Index on its own. Just want to go through the components of it, because some people might think, well, it's going up because gold and silver are going up, but not necessarily, because 30.1% of the index is energy, right? WTI crude, Brent crude, natural gas, heavy fuel oil, RBOB gasoline, and diesel as well. And then you've got 23.1% is grains, like things like corn, soybeans, soybean meal, wheat, and so on. And then 15.3% is industrial metals like copper, aluminum or aluminum, zinc, nickel, and lead. Precious metals, gold and silver, make up 18.8% of that index. Then you've got the soft commodities, agricultural, X grains. That's only 7.35%. That's things like sugar, coffee, and cotton. And then you've got 5.24% for livestock, live cattle, and lean hogs. So it's a really a good broad measure of all major commodities. So I think this bears keeping an eye on, because I'm going to also look at this commodity index compared to the 10-year yield, U.S. Treasury 10-year yield, that is. Of course, silver is still a really good place to be, and I want to talk a little bit about silver this morning as we look at the markets. So, because silver right now is up almost 50 cents at 51.67. It's up just under 1%. The low yesterday, I think, was around 50.26, and it rebounded well at the end of the day. Today, the low is 50.86. Had a look as well at the Fibonacci retracements, because I think they're important. From the top recently in October, I think it was above 54, to the low, which I think was around, just below 46, or Yeah, in the 45s. The 50% retracement is $50.08. So we're above that. The 50% retracement, they're important, 50% retracements. But for Fibonacci analysis, really, the golden mean or the 61.8 retracement, and also the inverse, which is 38.2, those are important. But the 61.8 retracement from the low to the all-time high is 51.15, and we're comfortably above that. Am I saying the correction is over? No, but it's looking better. We're still not out of the woods. Short term, that is. Yesterday, I listened to Rick Rule. He had the early morning keynote speech. Very good speech. He didn't use any charts or anything. Quite entertaining. And one thing he said about the gold market is that it's not a contrarian investment anymore, because we've gone from $250 at the beginning of the century now to above 4,000. And he's got a point there, even though I still think with the general public, it might still be a little bit contrarian, because very few people are still involved. Not just the public, but also big investors. They don't have too much exposure to gold. But be as it may, not contrarian anymore. So is it time to get out? He doesn't think so, and he used maths to explain it.